Hello and welcome to another edition of the CNBC-TV18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head-spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen, at least I remember in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else, but absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct. And of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one right here in our studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So with that short introduction, with a short preamble, let me dive straight in with the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is frankly still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So, Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being that actually this is de-escalation.
Sure. So obviously no one knows the answer to that, but this is about informed speculation. I would say, I mean, for instance, Ben's boss just came out this morning, I believe, and said, 100 to 150 is BlackRock's base case for, I can't remember if he said for a year or for years, but it was something like that. And I see that as a possibility. But let me make it very clear. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon. So my bottom line is we don't know. It's a probability distribution. I think somewhere in BlackRock's range is reasonable, certainly for the rest of 2026. And in the longer term, when all this, as you correctly point out, trickles out to the rest of the global economy, then we'll get down to lower prices as the global economy collapses.
And also several nations, considering the energy shock right now, are likely to increase their purchase and storage of petroleum reserves. How much can that push up prices, to your mind, Ben? Sorry, Art.
You want me to? Okay,
yes.
So we're talking about a few million barrels a day. If all the storage in the world could be released all at once, okay, it can't be. So we take 3 million barrels, let's just say, maybe it's 2, maybe it's 4, I don't know the right answer, and we weigh that against 17 million barrels, which is the shortfall. It's a rounding error. I'm not saying that we shouldn't do it. We absolutely should. I'm not saying it's insignificant. I'm saying it doesn't make that much difference. In other words, if we think about a man who's lost 20% of his blood supply and he's bleeding out on the ground, and we put a tourniquet on his leg, and now he's only losing 15% of his blood supply, the guy's going to die unless you get him to hospital very quickly. That's a very crude analogy, but I think that's a realistic way to think about this. Yep. In other words, yes, let's do everything we can, but let's recognize this is an urgent situation.
It is an urgent situation. And Ben and Art, both of you, I mean, I just wanted to come in here. Both of you don't believe that this is ending anytime soon. So am I watching the same news that you guys are, or you don't believe what President Trump is saying, or what is it? I mean, we've heard the man say on tape, on camera, of course, he said a lot of things, but he's also said this, and this is the latest, that we've achieved our aims and we're going to end this soon, et cetera, et cetera. So, Ben, you want to go?
Well, a couple of things. I think President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know, but it is at least possible. And secondly, and I think more importantly, of course, America is the US, they are the world's hyperpower, so we all respect and listen to them because of their heft. But they are not the only player here. So you have to think about also the mindset of the Gulf Cooperation countries, the Gulf Cooperation Council, including the UAE and Saudi, and to be somewhat straightforward, They've just had thousands of drones and missiles thrown in their direction, so they may not be in a shake hands kind of mood. And the same, I think, could be applied to Iran. So Iran, again, we don't know how much is posturing.
But countries like Qatar, Oman, etc., seem to be facilitating. I mean,
Yes.
a sit down of some sort.
You're right. So there's a blend amongst the GCC, the different countries within the GCC. They're not all the same, that's for sure. But I think in particular, the UAE, Qatar, Kuwait, and Saudi have been surprised, would be English understatement, I think, surprised at the centrality of their role in this war. I think they were very much hoping that they could be something like neutral. It's a conflict between the US, maybe Israel, Iran, and the GCC. And this was not, it turned out to not be correct. Furthermore, I think Iran, they have said they want to make it very clear that there's a price to pay. Iran, the IRGC, the leadership of Iran, perhaps want to make it very, very clear to these other countries that if you mess with us, you will pay. And therefore, again, it's not so obvious that they will just shake hands.
Well, that's the point, right? If you mess with us, there'll be price to pay. And here's President Trump saying we're going to stop messing.
So a couple of things. One is, I think even if President Trump stops messing, which again, I'm not so sure, but if that's the case, then Iran can decide, okay, now the punishment can come. Now the punishment can come. So maybe, we don't know, maybe we are only at the beginning of the economic pain. And I think I would say, just briefly, of course, we're all focused on energy. This is totally appropriate. But it's not just energy, by the way. It's fertilizer. Right. It's helium into semiconductor. So in a way, this is something like a 1970s supply shock on the energy side, multiplied by COVID in a way. Not quite, but there's something there making the point that this is going to be really a very serious problem for the global economy and for potentially U.S. political pressures as well.
But by the way, the betting market, poly market, right, the marketplace, or whatever you want to call it, 60% odds that the war will end by mid-May. Now, I don't know what ending the war, the bombs stop falling or a complete peace, the strait opens. I don't know what that question or that statement is, which the war ends, but poly market says 60% by mid-May. That's what they're saying. Art, you want to come in on the question? Are you of the view that this is just buying time before we see this continuing and intensify more?
Well, Prashad, I can say a few things as an American. President Trump lies all the time. I mean, that's not a criticism, that's a fact. He has not said a true thing about the situation in Iran for at least a week. So I discount everything he says as performative. I don't discount its significance. I just don't think it, I don't believe anything he says. The bottom line for me is that Iran is right now the strongest country on earth. It holds the entire global economy hostage to its control of the Strait of Hormuz. Okay, it's never been more powerful. It never dreamed of being this powerful, and it's not going to give that up, as you said and Ben said, without extracting a huge cost. Now, back to the bettors. Maybe the fighting ends. Maybe there's no more bombs by mid-May. So much damage will be done between now and May that, a recession would be an optimistic take. I don't want to be pessimistic. I'm just trying to objectively assess what's going on. And as long as Hormuz is only partially restored to flow, then all bets are off, and chaos, economic chaos, social chaos.
Art, if I can just ask you one thing. You saw the statement from the Iranian foreign ministry that they're going to allow non-hostile ships to pass through the strait, right? The problem is the strait and the oil not flowing. And they said, was that different from what we've heard before? Or there's nothing different? Earlier it was we're going to set ships ablaze, and this seems a bit of a pivot, right? In their own way, they can't seem to be negotiating when they're being attacked, but a bit of an admission that they also want this to wind down? No, you don't read it like that.
No, I think, the Iran lies a lot too. That's the nature of this dispute. Iran wants to set up a tolling situation where they can get revenue that cements their control. In other words, if they can get other countries to actually agree to pay them for passage, then that essentially gives them diplomatic recognition that they're in charge of the Strait of Hormuz, which strengthens their position and gives them a little money. Bottom line, Prashad, is we're back to the strategic reserves. Maybe 1 million, 2 million barrels eventually gets through Hormuz with some kind of tolling situation. It's still a rounding error compared to what the world needs.
Well, the point is well made, Art. Iran is militarily weaker, economically weaker, but strategically far more important today than it was prior to the conflict. But Ben, the advice in all this for BlackRock is you all have dialed down tactical risk and you all downgraded U.S. equities to a neutral.
That's true. And I think we are in a different investment regime now, reflecting a more complicated world. And as Prashant said in his typically excellent introduction, it isn't just this a very acute and frightening situation. It's tariffs. It's a sense of globalization in decline. You can't trust other people. You have to be more reliant on yourself and your own nation and so forth. And I think that's going to persist. Hopefully this current crisis will pass. But I think those continue to be, as the kids say, the vibes, right? Those are the vibes these days. So what that's leading to from an investment perspective is a much more fractured global market and India market, I think. So we have moved from previously really a kind of everything bull market where you should be risk on, don't touch, and that worked very, very well. I'm not condescending that approach. That was the right approach for an easier time, a more pleasant time. Now, in a fragmented, chaotic world at times, I think we're all going to have to work a little bit harder and be much more selective.
U.S. economy, is there a risk of a stagflation? I mean, the jobs data is weaker, inflation is rising.
There is a certainty of a stagflationary shock to some degree. And now I hedge a bit with to some degree, but for sure, we are going to have a price inflation problem, an increase. Inflation is already too high, by the way, and a growth slowdown. This is baked in the pie. Because last week was very important. We moved from a general concern from a global market perspective to physical damage. So this in particular was the Qatar LNG facility where the Qataris, they will be, I'm sure, roughly giving us a sensible timeline, 3 to 5 years to bring this back online. So this is, I'm afraid, even if we have peace today, the problem persists for some period of time, and therefore for your question.
Okay, so just one quick question then on the valuations of the Indian markets from an FI perspective. When we speak to domestic investors, they find the valuations of India very attractive. But foreign investors have been pulling money out. There's been an exodus. At what point do you think the FIs will be interested in the Indian markets? What will bring them back?
Soon, I think so. Like you say, the valuation is much more attractive. There's a degree of earnings stability and certainty. India continues to grow very well in the very big picture, driven, of course, by its very pleasing combination of great demographics and productivity, an ever more efficient economy, and so forth. All of that is still true. But as they say, capital is a coward. And I think global capital is very nervous to get ahead of the conversation we're having here and the uncertainty specifically around energy. So as and when, and this will happen, as and when we get any more certainty, some of the things that have suffered the most should rebound the most. And I think India will be on that list.
So in terms of emerging market, when we look at the whole world, et cetera, you guys do that, right? EMs, India's attractive.
Yeah,
within EMs.
We have a structural overweight to India within emerging markets for the reasons I mentioned. The phenomenal growth that is really at the scale of India is really unique on the planet. That persists. I think the AI story weirdly has been a problem in the sense that it's not so geared into India for now. But over time, can India, with its superb, educated and very huge workforce, can India leverage AI and become even more efficient? Sure, why not? Yep. So I think all of these stories, all of these thoughts for India are still true, but for the next short period of time, I'm afraid they are obscured by the geopolitical and specifically the energy problem.
Yeah. Art, you in the last conversation we had, you said, well, this is a world-changing event, right? That's strong language. Were you saying it for effect, or is it really a world-changing effect?
No.
Go on, explain that. Explain that quickly.
Yeah. So, I mean, energy is the economy. Okay. It is the blood supply of the economy, and everything that happens to energy cascades through the rest of the economy. And so we compare this to previous oil shocks or other financial shocks, And those occurred at a time when the world had a lot more options, had a lot less debt. And so we're coming into this in a very stressed economic and fiscal and social background. And the world can't really take much more strain. And this is over the top strain. So the world will not go back to 2025. I don't know what the world will look like in the future, but I promise you that this is not going to be something in the rearview mirror that we're going to look at and say, oh, that was scary, but it's over now. Not going to happen.
Time now for the tougher questions from the audience here. So we have our CNBC-TV18 Access members, but we also have our next set of panelists here. Sandeep Tandon runs one of the largest AMCs in the country. And Sandeep also used to run one of the largest prop books in India. So he knows a thing or two about trading. Sandeep, go on. Your question.
Very specific thing on oil only. See, yes, we are all concerned about the narrative or noise which is getting built, and it is quite concerning. But if you really look at the data, okay, when I'm talking about the employed volatility data of crude, it spiked up to 180, corrected to half, 90, which means smart people are not factoring this level of pessimism, what we are seeing around us. At least if that was the case, then vol could have been remain elevated for longer term perspective, which is not the case. In the last 7-8 days, it has become half. So that gives us confidence that smart people are not factoring this level of disruption, what people are looking at. And we always see that we all get carried away at that point, and we give up actually, So we are in that sort of capitulative sort of scenario, which is all our bullish thought process has been given up completely. So the Wall's data does not show. Just want to understand your perspective.
Yeah, so I slightly take a point from your question, which is people are not that bearish, actually. So that worries me a bit. So we have this shock is ongoing. And from our perspective at BlackRock, what is priced in the energy market has not really been fully priced yet in other markets. So we've had this uptick in the oil price, most obviously the spot price, but now the price for oil a little bit further out towards the end of the year is now much higher, suggesting the market is somewhat more worried that this situation will persist for some period of time. That should feed through into Rima's question for higher inflation, and this should give central banks a problem, meaning they can't cut, maybe they have to hike, higher yields, and then in turn, higher yields should be a headwind for global equities. So this is a little bit unsettling. Again, I don't want to sound too bearish. Of course, it also presents opportunities, to your points, I think. And will there be certain areas where the baby is thrown out with the bathwater? For sure. And actually, this is the moment over the next, say, 3 months when we can pick the longs that will make our portfolio returns for the next 5 years. So we're very open to this opportunity, but for now, I still a little bit worry that what's priced in the energy market is not yet fully priced in global bond markets and global equity markets. I still think that's got further to run over the next several weeks.
And there's also this thing that oil is a physical, the basic thing, oil is a physical asset, which is so demand and supply, whereas things like equities live in the future in that sense, right? So there is that element of pricing or mispricing, whatever you want to call it, right?
And on the physical point, just quickly, Prashant, like there is a risk of people who can't get it. So you can buy and sell equities. Maybe you don't like the price, but you can.
If you don't have it, you don't have it.
There's a risk not just of a higher price, but we're seeing talk in certain parts of Asia of shortages, which is also an acute problem building on top of the chronic that we're talking to.
Please, another question.
Right. Hi, good evening. We've heard the saying that, data is the new oil. And as I reflect on that, I'm smirking because it seems that oil is oil and data needs the oil today. Right?
Well put.
So just wanted to ask you, either of the panelists, what's your take on the AI trade in the US? Does that slow down the entire juggernaut? Will the GCC countries withhold their investments that's going into the AI trade and any other second-order effects?
Excellent question.
Thank you.
Ben, you want to take it?
I do. So it's been, again, slightly overwhelmed by, of course, the Iran situation. But the AI news flow over the last 4 to 6 weeks has been amazing. Incredibly positive in terms of the demand. No sign of a slowdown in demand. No sign of a slowdown in the CapEx. So people worry, is it a bubble? Will the CapEx slow down? There's no evidence of that so far. So I think the AI hyper mega super bull market is still real and ongoing, but will it suffer as a very crowded position in a general risk, I just sell everything, I don't even care what it is because I just want to hide in money, I think that's quite possible. So again, when I'm thinking about my laundry list of things I want to buy, maybe I'm not quite brave enough today, but I want to be brave at some stage in Korea with the memory play that they have. For energy, as you say, of course, is very thirsty for electricity and we don't have enough. So I'm not so heroic. I want to wait for some more clarity, but the AI trade, for your question, I think is still very, very alive, and the data over the last 4-6 weeks actually has been supportive of that. But again, it's been just completely overwhelmed, understandably, by the pictures and the reality of the Iranian situation. So I'm still very positive on AI, but I'm a pragmatist. Can it go down in this general risk-off? Of course it can.
I think wonderful question, and I think fantastic response there as well. You know, we could go on, and such a fascinating topic. And so many directions we can take to it, but we're out of time. Ben, I want to thank you for dropping by. A wonderful conversation as always. Great insights. Art, we'll of course keep tracking this with you in terms of where oil goes from here, and I think you've got a close eye as anyone has. Thank you very much for taking out the time and joining us from where you are. Well, that's the first panel really, but that's just the first. There are 2 other panels coming up. We'll take a quick commercial break here. We're going to come back and we'll ask the next set of panelists, and that's a pure market discussion which we'll be having, how to make money in the midst of this crisis. So that's what's coming up in just a bit.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
Welcome back to the CNBC TV18 Market Town Hall. As promised from global macros and the oil shock, we now turn our attention to opportunities in the market. With me is my colleague Nigel. Nigel, hi.
Well, thanks a lot for that, Prashant. Well, they say with crisis comes opportunity. And that's precisely what we're going to be focusing on here. What can you do to make money from here on? That's the big question. We have with us Mr. Harish Krishnan of Aditya Birla AMC, and we'll also be joined by Sandeep Tandon of Quant AMC. We'll be focusing on the micro opportunities with Harish and focusing on the macro opportunities with Sandeep. But before we bring them in, let's assess the damage to the markets since the entire war broke out. Prashant, take it away.
It's not a pleasant task, Nigel, but someone's got to do it, right? Assessing the damage, the tally, or whatever you want to call it. But let me go across and tell you exactly what's happened since, the 27th of February it was. Just absolutely a quick run-through in terms of what we've seen. And returns, basically, a big bite has been taken out of returns for investors. The Nifty and the broader markets have lost between 8 and 9% since the war began. The damage to the otherwise still recently resilient banking space has actually been quite large as well. The Nifty Bank has lost about 13%. This is all from the 27th of February close. But it's not just India, right? Look at the damage to other markets in Asia as well. Markets like Korea and Indonesia actually have lost the most, 14.5%, 15% in that range. You look at flows, FPI flows, which had turned briefly into the positive the month before. They've turned negative once again. FIs have sold big, and you can see that almost $10 billion or so. But who's on the other side? It's locals. Those SIP inflows providing some amount of counterbalance coming through. Now look at commodities as well. There are fears of demand destruction. There are also input shortages with regards to metal processing, etc., which basically means that base metals have taken a knock as well. Things like copper, aluminum, not so much, but a bunch of other things. Gold and silver, magnificent rally over the last couple of years. And they were all the rage through the first 2 months of this year, but they've taken sharp knocks. Gold prices at about $4,300 at the lows recently were basically back at where we started this year. And of course, valuations will come up on your screen as well. So I'm just using the Nifty, the mid-cap index and the small-cap index. And what I've done is not taken forward estimates, but trailing earnings, P's based on trailing earnings, because the future is always uncertain, but it's more uncertain right now. But on a trailing basis, Nifty, P multiples at about, 18 point something compared to the 10-year average, which is about 20 plus. Mid-cap index, small-cap index. Basically, valuations have come off. The question is, have they come off enough for you to really jump in and deploy some serious amount of money and do some sensible things? That's the question. Let me invite Sandeep Tandon and Harish Krishnan. Gentlemen, if I can request you to come up on the stage, and we will ask both of you, exactly that question, what to do. Please. Welcome. Thanks. Hi, Harish. Please.
Thanks.
So let's start right there, guys. And, we were having this conversation earlier on the earlier panel, right? It's not just this one shock. It's like shock after shock after shock. Start with the tariff one, then there was the AI one, and of course now this is the oil shock. Let's start with the latest, which is this oil shock that we've seen and the 8-9% correction in the index. Have valuations become reasonable? Harish, let me start with you.
Sure. Clearly, as you said, that this is the here and now, but I just want to kind of contextualize. In these 18 months, we've kind of focused on 5 key resets that have happened, right? We've had domestic demand getting fired by tax cuts. You've seen rate cuts happening. You've seen a currency upgrade in the form of a sovereign upgrade. You've seen trade deals with 70% of the world economic output. And then you also are starting to see a transmission of rate cut cycle. This is what had happened before the war kind of broke out in the Middle East, right? So when you are a farmer and you start looking at, say, owning the farm for the next, say, 50 quarters or 70 20 quarters. What happens in the first 2 quarters has got very little meaning compared to the overall competitiveness that eventually will start coming through for the farm. So therefore, we think that, in this kind of a framework where we've done a lot of hard, heavy hitting kind of shifts in policy response to all the other issues before this kind of development, we should kind of look at this correction very favorably rather than to get worried about. So that's point number one. Secondly, to your question about energy shock and therefore, is it only India that's going to get impacted or is it going to have a cascading impact to the rest of the world? Let's draw our attention to what happened in the Ukrainian conflict, right? Now, at the Ukrainian conflict, at the peak, when there was an overall commodity boom, and do remember that at that time, agri-commodities went up through the roof, overall crude shock was roughly about 5.3% of world GDP. At today's prices, it's close to about 4.6, 4.7% of world GDP. That's where the total spending on crude, if this were to annualize for the whole of the next year is concerned, right? So there's still some gap, but the bigger thing is the Western world had far lower interest rates at that point of time. Today, a lot of that is being fed into the Western world, and that is going to have a far bigger knock-on effect, right? So therefore, if I were to contextualize, can the world really absorb such huge amount of shock absorption? The answer is no. And which means that we think that it's going to be a lot more pragmatic, that both the administration in US and hopefully the Gulf Council kind of puts their heads together and kind of de-escalates the situation rather than letting it go out of control. So if that be the base premise, we think that, valuations are reasonably attractive in a lot of parts of the market, and which is where we think that, rather than get obsessed about the next 3-6 months, let's look at companies which have become more competitive and which are on the right side of all of these disruptions.
Nigel, what we'll do and what we thought for our viewers, what we'll do is we'll divide this conversation after getting initial comments from you, Sandeep, as well. We'll look at the 3 disruptions, the big AI disruption, tariff disruption, and energy disruption. We'll ask both of you, which are the companies, sectors, which are on the right side of this disruption? Which are the companies which actually, for the lack of a better word, benefit or get hurt less? So that's what we want to do. There's one framework to use. But Sandeep, just to sort of kickstart and get your views, you use so many tools to analyze where we are at and whether things have priced in a fair amount of damage, or is there more to be done here? So what do you say to that question?
So Prashant, let's start. We the beginning of the year, I described 2000 on this one of the panels out here. We talked about fragile 2026 and as a PE contraction year. And we also talked about correction in global equities, particularly DM, and we talked about a massive correction in silver and gold, because that's the euphoric move which we saw. Now, if you really look at, it has corrected a lot, okay? And we think we are getting signs of capitulation now, where even bullish thought process is getting capitulated. There's a typical signs where best of the global houses makes big targets about crude. This is not the first time we are seeing, It's a human reaction, when you are in pain, you will try to see that everything has changed. But the fact remains that the relevance of oil has already lost as compared to what was earlier years. Now it's a gas and we are getting renewable. Now, if you look at the Walls data, the question which I asked, my point is that maybe yes, this month oil can remain elevated based on our predictive analytics. In February, we talked about that oil will rally, and we talked about dollar index risk to the global equities. And I think has played out. My view is that this will not last for long, and we are in the final fag end of that crisis, maybe get extended by a few more days. That's what data is showing, okay? And if you ask me, the beginning, by the end of the year, where the crude will be, I think it will be below 70, okay? So where the concern, this is how we reverse calculate based what we call it market implied analytics, okay? That is our data is showing. So I will go with that thesis, the data is got, okay? And we are slave of data. So I'm not that much concerned the way people are panicking. Yes, obviously manufacturing sector will be affected. We have issues on the utility side. We have issues on the input side. We have issues on the output also. We don't know the trade related or the logistic challenges which we are seeing. But I think every crisis has opportunity. So I think I will look as an opportunity because India has already corrected a lot. We turned negative on India in July 2024. And I said in January, what was the situation in India in July 2024? Something similar is there in January 2026 for US, and something similar is there for Taiwan and Korea in 2026, where whole world is very gung-ho about Taiwan and Korea now. We think we are getting signs of complacency out there. I will not say a maniac sort of thing, but there is signs of euphoria. I think the way I look at maybe beginning April, India has opportunity to outperform global equities, and India will fall less. And maybe by end of the year, in absolute and also you will see a new all-time high in the indices. Okay, I will not be surprised at all to see maybe by the mid of the year also. So I think this is a classic phase where everybody is giving up. Capitulation is there, and when we talk about equities from longer term perspective, but unfortunately peak of the cycle, every investor has a very high risk appetite and he's a long term investor. When 6 months later things change, I think if we have thought process, this is the opportunity, then I will like to increase our equity exposure. We were sitting on large amount cash. We have deployed up to large extent in this fall. So we like to use this as an opportunity. I think it's a brilliant opportunity for India after maybe 2 years of underperformance.
All right. Take that thought very, very seriously, Sandeep, because the last time we were on the panel, you spoke about 2026 being a challenging year, PE getting derated, but you also made a point that India will outperform, and you're sticking to that stance as well. So maybe we're in for better times from here on. That said, a war like this throws up very opportunities in the post-war scenario. Could you tell us the top 2 themes that you're looking at, from here on? Power could be one, I think, so is something that you're bullish on. Yeah. But run us through the rationale on those 2 top themes.
See, we have been, if you have to really play data center story, I think power is a theme, like how we played copper for the EV thesis in the past. I think power or energy as a sector is a great opportunity. That's one of the reasons we have more than 20-30% exposure in this space. Okay. So that's the one space which we're looking very constructive. Second space, as compared to IT, we like pharma as a space. I'm not saying all the pharma companies, but a lot of generic companies. And we have to keep in mind some of the pharma company will face challenges on the solvent side or their raw material side, which is a derivative of crude in some manner. So those are the areas which you have to exclude. Then I still like in the current context the BFSI space, private sector over public sector. We still like insurance could be opportunity. Asset management company itself is opportunity. Wealth management companies are thing, because asset management companies are serious threat to banking from a longer term perspective. I think great businesses which is getting, we are also part of that industry, so we understand that space quite well. And I think other areas which have to look at should be the sum of the consumption theme. The FMCG stocks particularly, they are still expensive. On relative basis, they have corrected, they have underperformed. Many stocks are in the neglected zone. So I will look for food processing companies also should be opportunity. And if I have to avoid at this point in time, I think it's a manufacturing space, because we really don't know. And none of the companies will going to really explain, because they themselves also don't know how exactly it will. So more from a conservative approach, I like to avoid manufacturing company. You cannot avoid completely. So I will say I will dilute these holdings and look for opportunity once we get more clarity on numbers, maybe down the line a quarter or so.
Okay, all right. Harish, let me get you in there. Now we look at global markets and we look at PEs, return ratios and the likes. You have another way of looking at it as well in terms of India's market capitalization as a percentage of global market capitalization. Could you tell us what does that come down to and what does it compare with in terms of averages? Is it lower than what we've normally seen?
Sure. So India's share of world GDP of economic activity is roughly close to about 4%. Okay. Roughly a $4 trillion economy on $102 trillion global economic output, right? And if we tend to grow at anywhere between 9 to 11%, and the world growing in nominal terms anywhere between say 4-ish odd percent, give or take, how it eventually pans out. You would think that, this number should be anywhere between 7 to 8% over the course of the next decade or so, right? Now, it is in that context that you should look at the India share of market cap. Right. Okay. India's share of market cap is currently close to about 3.1%. Okay. In the worst of times during the Ukrainian conflict, we kind of bottomed out at about 3%. In the time, in February 25, again, we bottomed out close to about 3%. Now, 3% is not some Lakshman Rekha that will never get broken. But if you are a serious long-term capital allocator and you see that big shift that India's share of economic output is going to rise in point of time to come, if you're going to buy in at 3% of world market cap, you generally should be looking for a very big asymmetric kind of a rise. And this also needs to be contextualized for the fact that, from US, there can be a lot of flows going outside. There's been a lot of money which has chased US assets over the course of the last 15 years. What happens if there is money which is actually going out of US, given the fact that it's exceptionalism, be it on innovation, be it on, let's say, security, be it on the safe haven status, all of that comes under question mark. So I think we should be kind of looking at these opportunities as well. So I would think, therefore, that, now is not the time to panic.
Yeah.
Now is
and
the
I think
time to kind
the
of
point
add
you
on.
made, Harish, earlier, but you used the farmer analogy, right? I think it's such an important point that trying to finesse too much that I'm going to buy 2% lower, 5% lower, over a 10-year period, it's a decimal
Counting
point
error,
change, right?
yeah.
It doesn't matter in that sense. If you're broadly right in the ballpark. So let's talk about what are you doing right now? Let's take energy. I said I'll ask you about energy disruption and who's on the right side of it, right? So who's on the right side of it, Harish?
So, unfortunately, we are all losers because broadly we are large importers of energy, right? But within each sector, when you look at it, there are certain energy efficient players compared to the others. Now, these are going to have outsized gains because in this environment where the going is going to get tough for everyone, the last man standing is the one who is going to take the most out of that, right? So, if you look at, say, some of the larger sectors like, say, cement, which is in effect a huge energy user. I mean, cement is all about transferring from one energy form to another energy form, right? Now, over there, if you've got an edge in form of energy conversion, that is like real solid gold today, right? And that is the one that is going to compound for you in terms of that difference and that dispersion. And that is going to help you gain market share in a very difficult environment. So, I think that would be one area. Similarly, if you think about this entire unorganized to organized in, say, building materials, we've seen a huge amount of unorganized players operating in the building material space, be it in pipes, be it in tiles, be it in ply, be it in other forms of consumer durables, etc. The reality is that a shock like this, typically the weaker hands don't have the purchasing power to kind of remain in business. Again, therefore, there's going to be a greater formalization and a cleaner balance sheet that's going to sustain through. So our call is not that, we have any edge to predict what the next 3-6 months is. But if I am able to identify and distill certain companies which are going to go one leg up compared to the rest of the competition, okay, that gap is likely to sustain for years to come, and that gap is what is going to get alpha for our unit holders. So that would be another area which I would say can come through. Another area could be, there's going to be this huge rebuild that's going to happen in Middle East. I mean, the war cannot go on indefinitely. And imagine the amount of desalination plants that have to come through. Imagine the amount of pipelines that have to go through. These are all economies for whom this is the bloodline, right? And they're going to have a massive amount of capex that's going to come through. At this point of time, of course, there is all this fear. But what happens if even the Ukrainian war kind of stops out? Okay, how about the entire kind of that region wanting to kind of rebuild? So I think these are all opportunities. See, markets are about spotting asymmetric opportunities where the optionality is not being priced. And today we are seeing so many such opportunities which are there, which is why we are not so worried about how to kind of navigate the next 3-6 months. I think if we try and over-optimize that, we're going to miss the bigger opportunity that's going to come through, which is where I would say that, as an investor, one should train their eyes on rather than looking at how do we survive the next 3-6 months.
Cement, building materials, and
pipes,
and,
even chemicals for that matter.
Yeah.
Right, there can be a whole amount of inventory rebuild because post the last 2 years, the big problem has been a destocking problem globally. Now, if everybody wants to get back into that supply chain, there can be a bullwhip effect of inventory again going back. So these are all things that are hypothesis. Nobody knows whether they're going to play out in Q2, whether they're going to play out in Q4. The idea is that you kind of identify the best run companies which are positioned and who can execute for that opportunity, and then you can.
Harish, I know you can't talk about specific stocks, of course, because of regulatory reasons, but we've taken the liberty to use your fact sheet in terms of what you own in the fund, and we're putting them up on the screen for our viewers in each of these segments, each of these areas. But within each of these, the 4 segments that you mentioned, you got to pick what is lesser insulated to. I mean, that's what we started with, right? I mean, more competitive generally.
Yes.
The best, the most competitive actually.
Absolutely.
Compared to the others. So it's not like the entire sector, but specific names. And I think that's an important point to make. It's not a call. It's a call on the sector, but also on companies in that sector.
Absolutely. So it's a call that, as the previous guest was saying, that if the baby is thrown along with the bathwater, That's the time that you have to actually look for the baby, right? And a lot of these sectors have actually kind of got binned, right? And mind you, these are sectors that have underperformed over 3-5 years. It's not that these have been darlings and suddenly because of this they have kind of cracked. So therefore, there is reasonable margin of safety. A few trades going right over there can make a huge difference for the fundamentals of many of these companies.
All right, very quickly, Sandeep, I want you to comment on this. One of the holdings that you'll have is in a company, Sun TV, and there is this lot of buzz with regard to the IPL valuations going at $1.5 to around $2 billion. Who would have thought? It seems there are companies like this, there are value out there. What do you make of this recent deal closure that we've seen on the IPL? And do you believe there's a lot more scope? Because if you compare it with global leagues, then still there's a massive runway ahead.
So Nigel, the fact remains that it's a new area and people have a lot of excitement. So you don't get into the valuation because valuation looks absolutely absurd, okay? But the way globally this business has built, I think India also has potential to, so far it's only about cricket, but you look at the women's leagues that are coming up, the hockey is also getting built, and many other sports which the current government is also focusing a lot. I'm also very optimistic about this space. These are the space which people will look from a longer term perspective, and valuation globally has been expensive. So India being a growth area, you can give a premium on the global valuation also. So I think it's a great opportunity from long term.
Okay. All right.
Okay, I think we can open it up, Nigel, to our audience and maybe take a question or two. Gentlemen?
I want to ask a question.
Yes.
I want to ask a question to both the guests.
Sure, please.
Two-part question, one to Harish and one to Sandeep. First, Harish, to you. From a retail investor point of view, we all know
If you will just hold up the mic.
everybody's portfolio is bleeding, right? So all have been investing into mutual funds or direct and whatever. In the last 18 months, nobody's made money. Portfolios are bleeding down 30, 40, 50%. As you said, this is a time to buy. But what should one do with the existing portfolio? How should they, churn the portfolio within that? And how should rebuild? Like the whole question is, from a retail investor point of view, what would be your advice to rebuild the portfolio given all the uncertainties which are there currently?
I think this is true as much for retail investors as professional investors, right? So the way we frame it is that we've been through a phase of reboot. In the last 18 months, there has been a lot of activity. Of course, the latest one is what we are seeing, okay? Which means that we need to refresh the portfolio, which is not to get anchored by the winners of the last cycle. We are going to see a complete different set of winners.
That in your
we would
your
like
schemes?
to believe so, but can there be room for improvement? I would certainly think
So what's the mantra like? Sell off your bad investments or just book out the...
So one is, of course, investments which haven't kind of worked out, book losses. I don't think there's any shame to admit that investment is a probabilistic endeavor. You will make bad decisions, right? But to kind of identify that and bring it to closure, because that releases capital to more efficient ideas. Yeah. And therefore, you need to start looking at it from a new sense, new lens, right? And which is where we are saying that, the leaders of the next market cycle over the course of the next 3-5 years are going to be very different from the leaders of the last 4-5 years.
Sure.
Okay.
Have you identified one or two leaders?
So I would say that, sectors like...
If I can to answer that, if I can urge you to talk about you said the new things, right?
Yes.
You are very bullish on new age businesses.
Yeah.
Go on.
So I think, see, for example, if you think about new age businesses itself, okay, now they've created wealth overall, but in the last 6-12 months, they've also taken a very big knock. But if you look at overall new age businesses, they account for roughly about 1.5% of total market cap, okay? If you look at historically, what has been the proportion of market cap in loss-making companies in India, that's been anywhere between 5 to 6%. So India has always had loss-making companies, okay? But today, when you look at new age companies, what is it that their problem is? Their problem is that they are spending a lot of dollars in acquiring new customers, okay, trying to create a new habit, and then to try and make profits come through. I think in the world of AI, the cost of acquiring new customers can come down very drastically. And therefore, when you've got, say, only one large player in a particular area, which has, say, 25 crore users, these are not easy numbers to get through in any sense of time. their ability to crank up a profit will surprise many people is our sense, rather than to kind of be dismissive about them. So we believe that, you know, a lot of these companies, AI can actually be a very big beneficiary on, wherein on the application side, they can come up with way new approaches to try and target the same target addressable market. So that is again an area where we are extremely positive on at this point of time.
Sure. Sandeep, to you, we've learned this over the many years that if you identify the right theme and you write that theme, even the worst performing company makes a lot of returns in equity markets. The last 2-3 years, the big theme was EMS. With this given context, anything that comes to you that is going to be the next big theme where even the worst performing company can make money for you?
So let me add your first question, which Harish has already covered. See, when we talk about the portfolio management, it's not about absolute return. It's also about a relative opportunity. Okay, so sometimes you people have to learn that people have thinking, you know, I bought at X price, it's corrected sharply. It's very difficult to sell. That emotional aspect comes into picture. When you do ruthlessly rebalancing of your portfolio, so then you have to look at from current level whether these stocks have potential to move up further or they have potential to fall. If I'm getting a better opportunity, we should switch. Okay, that's the best thing we should do it. Second thing, what was the second question?
On the next big theme, like, any theme that you've identified which can, because, we've realized the worst performing company also in that theme makes a lot of money for the investors.
Didn't get best tea, but worst be tea
and that's the example in EMS, right? The best company made 20x returns. The worst company also made 2x returns.
Yeah.
So first of all, Nimesh, we have to look at with some, obviously this sector has given extraordinary returns. But I think these type of stocks have significantly over ownership. My biggest worry,
From here, given the
I'm coming to that.
Global environment, what is the big theme?
So I'm just linking with the over ownership thing. See, we have seen underperformance so far by all the over ownership where the FIs was there. Concentration risk was very high, and we have seen banking is a very classic example how we got butchered. My next worry is the over ownership on the domestic mutual fund side. Okay. That is also a lot of skewness we are seeing, and that is the pain point which we are seeing, and we have seen some amount of underperformance already started. So the theme which you have to look at, we have to identify beaten down, neglected themes, which is like people believe their hated zone sort of thing, or some of the companies where you have a lot of issues in the past. I think if you can identify the trend which is changing, I think pharma is a theme. Okay. Power sector is a theme. They have corrected a lot. Okay, a lot of people are still underweight on the energy and the power sector side. Pharma is grossly underweight both from the domestic. I think these are the themes which you can look into it. I talked about asset management and wealth or companies also. Insurance also in something similar, neglected zone for last many years should be opportunity.
Okay, I think we could go on, but I'm being told that we are on a clock. And the clock is running out. But I think wonderful insights from both of you. Sandeep, thank you very much for dropping by. Harish, fantastic. And I know you had more. The tariff, who's on the right tariff discussion, that's another time. Thank you very much, both of you. I think from Nigel and Mays, thank you for staying with us. But stay right here because Neelkant Mishra and Sajid Chinoy will tell us we're going to stress test India's macros. That's the next discussion coming up right after this quick break.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at...
Welcome back to the CNBC TV18 Market Town Hall. Of course, the Iran war, the war in the Middle East, whatever you want to call it, of course, is the focal point. And what we're doing on this third panel here today is assessing the damage to India's macros. Put another way, stress testing India's macros, and can it take the damage with regards to this oil shock? And will oil prices linger higher for longer? That's the big one, which no one at this point has the answer to. Lata.
Yeah, and what can the government do to mitigate this damage? That's also the focus on this macro discussion. We have two stalwarts who need little by way of introduction, Neelkanth Mishra of Axis and Sajid Shenoy of JP Morgan. Gentlemen, thank you very much for coming by.
Thank you for having me.
To be here. To our do. Sajid, we have to talk scenarios because we don't know. What is your base case in terms of hit to the economy and what is an adverse case?
So I'm stating the obvious by saying there's just so much uncertainty. But Lata, I'll tell you why this is different from previous shocks. So typically when you get an adverse supply shock, like the kind you're seeing, it's stagflationary, right? We've seen that growth has to be marked down, inflation has to be marked up. That happened in 2022 in the Russia-Ukraine war. What's different about this energy shock from the past is that there's, of course, an adverse terms of trade channel through higher prices for energy importers like India. But the concern this time, after a long time, is actual availability of volumes. With half our crude imports coming through the Strait of Hormuz, a significant fraction of gas, the concern, not just in India, but all of Asia, there are many Asian economies more vulnerable than us, is if this goes on for several more weeks, will actually be a lack of availability of energy. Now, why do I say that? That's going to force industrial shutdowns. We've already begun to see in some countries rationing has happened, right? There's work from home in other countries. And that has a very material impact both on the outlook for growth, but also how central banks think. Because then, see, if there's no hit to activity because there's no shortage of availability, you're in a 2022 scenario where inflation goes up and central banks focus on that. But if suddenly there's a lack of availability of LNG, LPG, rationing, then think of this more like 2020. Think of this more like COVID. And there are two implications that flow. One is we've seen from COVID, outcomes are very non-linear. Once a business or activity shuts down, very hard to reverse that. Once a gig worker goes home to the village, very hard to reverse that. So then you begin to worry much more about the impact of activity and the hysteresis from the shock. In that environment, a central bank who's faced with this uncomfortable trade-off of weaker growth and higher inflation will focus on the former, will focus on weak growth like COVID. So the reason I'm not giving you an answer is because we're very early in the process. If this is more like COVID, I'd worry more in terms of growth outcomes. If this is more like 2022, you'd worry a little bit less about growth. And therefore, the last thing I'll say is the near-term policy implication. We think about monetary and fiscal policy in a bit. I think there are three stages to the response. The initial stage has to be in the next 2-3 weeks. How do you procure energy availability like your life depends on it? Right? The shadow price of a business closing down is almost infinite. So anything that we can get from the high seas at the spot price, whatever price it is worth it. So I think that has to be the overarching thing. How do you augment domestic production? How do you get imports from wherever else in the world? And thirdly and finally, how do you allocate scarce resources efficiently? The temptation is if you have a certain amount of LPG, give it largely to households.
I take all your points and policies, but I'm still asking whether you have a number. You know, like 7% was what...
So the rule of thumb is the following, right? That whatever your starting number was, say it was 7% for FY27, every $10 increase in crude prices is about a 0.4 to 0.5% of GDP adverse terms of trade shock. How much that translates into growth will depend on how much is borne by the public sector versus the private sector. Ironically and paradoxically, the more the public sector bears, the larger the hit to growth. if the fiscal deficit doesn't change, because it's a one-for-one loss in other spending. Now, if there's an impact on a lack of availability, Lata, then for every $10 increase in price, the 50 basis points, you have to add that on. And therefore, it's so difficult to make an assessment so early in the process.
Nilkant, I mean, Sajid, you heard him, right? I mean, in terms of, one is the price that you're paying, and the other is the availability itself. Right now, the shock is in terms of the price. Availability, yeah, I mean, we are doing some things, but it's not led to shutdowns. It's not come to that. There's some rationing and allocation to consumers in terms of who gets what first in the priority list. But your thoughts, Nilkant, as you look at this?
So the first thing is, this is a global problem. This is not just India's problem. And I'll tell you why it is important. So at the face of it, there is, as we've discussed in your show earlier as well, that about 20% of oil used to go to the Strait of Hormuz and 2.5% of gas. You do the maths, it's about 7% of world energy. There are clearly now the East-West pipeline in Saudi Arabia, there is Kazakh oil, Russian oil, Iranian oil, all of that is now coming to the market. So net impact may be close to 4%. And there's also energy substitution and all of that. Now, 4% of energy supply going down is 4% of world GDP going down. As simple as that. Now, we can discuss allocation effects, like who will bear the loss. For example, Gulf airlines are shut or have slowed down significantly. That's apparently 1 million barrels a day. Okay. There is, counterintuitively, because our retail prices are unchanged, our oil consumption is not falling. But if you have a free market like in the US and prices at the pump are going up,
consumption will
then
fall.
Consumption will start to fall. So it may be that initial stages, the reallocation of that 4% energy supply, I mean, who bears the loss, may actually be in very different markets than what intuition will suggest. But I think now the stress is, the markets are already worrying about non-oil stress. So you saw that in the problems that in the Monday market, Korea was down 6%. India was down about 3%. Japan was down 3.5%. China has started to fall. I think we are already hitting a stage where second order, third order supply chain effects are showing up. So
chips.
Yes. So if there is no helium, if there is, or the simple effects that we saw on the first day, that if you don't have LNG, you can't paint cars. You can't paint cars. There's a whole supply chain shock that is going upstream. So as you start to see, like copper falling, gold falling, one can perhaps explain that, saying that incremental buying was coming from central banks in Asia and in West Asia, and now one side is trying to protect the currency, the other side doesn't have money. But now you have copper falling. And so clearly, I think
So there's demand destruction in that sense.
Yes, and supply chains are now, the second, third order effects are going to be so complex, which is why I think the pressure from markets. So you saw now that the UK gilts are up 75 basis points in 1 month. The US 10-year touching 4.5. I think the financial markets will force everyone to stop fighting and bring down the problem, right? So the question for us now is, if the fighting stops today and the Strait of Hormuz, say, opens, say, 1 month later, and I told you on the show 15, I'm still sticking to that if it doesn't open up by 15th of April, I think we are staring at a severe global recession. In which case, India may not be the worst market. So that is why I don't see these scenarios. I'll tell you the scenarios, right? So as Sajid said, it is very straightforward. So if you have $100 a barrel for 1 year, you have 2.1% of GDP gone. How much of that is fiscal? How much of that is, so basically you borrow from the future and spend today, and so on and so forth. There is about a 1.3% impact on inflation. There is a $60 billion balance of payment shock. So these are easy to do scenarios. But I think the harder call is, when both warring parties, and we have to include China on the side of Iran. So China and the US is backing the two fighting forces. When do they feel the pain strongly enough that they force concession?
That's a great point. But since you spoke about, if there is a recession, we may not be the worst market. We may not be worsted. One of our problems, or our Achilles heel, has been the rupee. Because even if our current account deficit is small, we have not had enough capital flows. Now, even at a time when our GDP was doing well, corporate earnings were still in mid-single digits or thereabouts, not attractive enough for capital flows. How do you see FY27? I mean, do you see a turn? We thought that fourth quarter is when corporate earnings are going to turn. Now it looks like that turn is not going to happen. How do you see corporate earnings in the next couple of quarters?
Yeah,
I'm not even asking
in my view, if you ask me, if it doesn't look like this is, I mean, while the markets are celebrating today, I don't think this is over yet. I think that there's another 2-3 weeks of game theory, move Marines in, not move Marines in, threaten them, and all of that. So all of that will happen. I think my biggest concern, if you ask me, and I'll answer your question, is that you end up with an agreement with someone you think represents Iran, but then you find that they don't really control Iran. Because, see, in order to survive, I think the Iranian regime has decontrolled or decentralized operations. And it is quite possible that one guy says that, okay, fine, this is great for us. But the other guy says, you saw that, the foreign minister says something.
Capitulation can.
Exactly. So it is quite possible that the Strait of Hormuz is closed, and now we are fighting a very different kind of battle, right?
It's an ambiguous piece. You don't really know.
So that's what I worry about. But I think that if it doesn't end by 15th of April, I think...
But Nitin, you do believe it will end by the 15th. That's that you think, you said a couple of more weeks. So you're saying, in your mind, you think that it won't go beyond that.
Yes. And as I said earlier, markets are a part of the war now. If the markets don't panic, it continues. If the markets panic is when everyone says, oh God. Because see, it is so complex to model, as Sajid was saying, it is impossible to figure out if you disrupt oil for 3 weeks, if you capped a gas field or an oil field, how much time does it take to reopen? Once you reopen, how much hoarding will happen? Do you have enough tankers to move things around? So if you are stuck for 1.5 months, it may take 2-3 quarters for everything to normalize. In which case, how do you assess economic impact and the supply chain and the complexities? So everyone is looking at the markets to tell them how bad things are. And it is when the markets and it's when the bond markets start panicking, is when people say, oh God, now we need to pull back.
That point is well taken, that markets will discipline the parties and hopefully, therefore, that 2-week period works. But I'm genuinely worried about capital flows because the rupee, our inflation and growth are not our problems. Our problem really is the currency. And okay, that point, do you see capital flows returning?
I think earnings cuts will accelerate, re-accelerate. So we saw February as a very good month.
So capital flows are still a question mark.
But capital flows is not just FII portfolio flows, right? Capital flows are also FDI flows. Capital flows are also FDI repatriation. See, the reason why we think balance of payment impact will be less than the terms of trade shock is that, look, FDI repatriation for us used to be 20 billion a year. Because of the stock market action and the VCP exits, it had gone to $50 billion a year. That $30 billion is stuck. Which IPO is happening right now? When you see gold was adding more pressure. Now gold is down from 5,000 to 4,000.
So the same ETF pressure may not be there.
That's the point I'm making. So look, this obsession with FPIZ, they're not principals, they are agents. And at some point, see, as of now, of course, people are questioning, oh, so much of money used to come from West Asia. But now money will come from Norway. Okay. Because they still are supplying oil, their oil supply is undisrupted. So I'm not too worried about capital flows, especially if it is for a period of a month. What's the point of having $700 billion of reserves?
Do you think the Reserve Bank or government have to take something extraordinary? Like, oil companies directly buy from Reserve Bank, buy dollars from Reserve Bank or oil bonds. Or even as Indonesia has gone to the level of, capital controls. You can repatriate, you can remit only $50,000, not 100,000. Any extraordinary measures?
So I don't think that's a good idea because I think that adverse signaling impact of doing something extraordinary in a crisis suggests...
They won't do it voluntarily. Will they be pushed to it?
No, they will not. India still has enough reserves to go through for the next 2-3 years. In fact, I would argue we could be intervening more and letting the rupee depreciate less. And that would, in my mind, be a policy mistake. Let's step back here. We want, when crude prices go to 100, to elicit a behavioral response. You want Indian consumers and businesses to conduct economic decisions, keeping in mind energy is at $100 a barrel. How do you do that? that's where prices are going to affect. So therefore, you need to do two things. The internal shock absorber is, over time, in the next few months, if crude remains elevated, and one quick digression, even if the war ends in the next couple of weeks, for the reasons Neelkant mentioned, supply disruptions will take many months to unwind, and we're forgetting on the demand side, many countries have begun to run down strategic petroleum reserves. What's going to happen post this? Everybody goes back to where they were and further. India will want more SPR after this. So you're going to be in a situation where supply takes long to come back on stream, demand's going to be above normal. So crude could remain elevated for the next 9 months, even if the war ends next month. In that environment, you want consumers to see the actual price, which means over time, I would argue, gradually raise retail prices so that you get the volume adjustment to higher prices. If you worry about the current account, Lata, we've discussed this before. There is any amount of evidence in India, some of which we've done in the last 10 years, which shows over time, a real effective exchange rate that depreciates does improve the balance of payments, current account and capital account. So if you're thinking from a 12-month perspective, the right and healthy thing to do is let retail prices go up, so volumes adjust, and let the exchange rate gradually depreciate so that the external sector becomes more sustainable. That's the internal and external shock absorber.
Sajid, JP Morgan, globally, we had a discussion earlier, and we had an oil veteran who said that they were building in I think it was BlackRock, $80 for some time. Is that the view? Even if the war were to end tomorrow.
Yeah, so exactly. If the war were to end tomorrow, I think the sense is that the second quarter would still be somewhere between 80 and 100, given these stickiness in the supply unwinding, and you gradually go back towards the scenario towards 80. That would be a kind of a benign outcome. And
2 quarters?
Yeah, to the end of 2026. Okay. Right? So you go from 80, gradually drift towards...
You average well over 80.
You average well over 80.
Have you cut growth estimates?
Not as yet. Because my biggest worry is, see, if growth were to average 80 this year or 85, Prashant, I think at that point the impact is not very large. We were working with $70 a barrel. If it's, 10%, 15%, this is going to shave off 30, 40, 50 basis points. I come back to the first point I made. If you get shortages in Asia over the next 6 to 8 weeks, the non-linear hit to activity is much larger, as COVID taught us. So,
do you think, Lata asked you whether the RBI will have to do extraordinary measures?
Yes.
My question is on financial market side, but do you think the government will have to kind of put in place measures which lead to lower consumption of things?
So I think the natural way to do this is to let prices reflect their opportunity cost. But I think
there are elections around. I don't know if that will happen immediately.
But even if it happens a month from now.
May I interrupt at least one audience question? Because
we'll take not one, Lata, we'll take a few.
Just 10 seconds to say, there's a well-established playbook that both the RBI and the government can follow. If there are sectors under pressure because of a lack of availability, what you need to give is sector-specific forbearance, sector-specific support, sector-specific liquidity. So we've learned from COVID how to handle a non-linear supply shock. And I think that's what should be the first order of business.
I want to ask you about that earnings. You were just about getting started on that earnings cut question. But maybe just take a question from the audience and we'll come back. Please.
Can you hear me?
Yeah, please go on.
My question is to Mr. Chinoy. So, disruption of Strait of Hormuz, we already know. It has impacted real estate of Dubai already. Now the impact has slowly started in South Mumbai also. I can see 5% increase in, some of the luxury properties. So, is it going to remain constant or, this is going to be changing? Because everybody's saying that, I think it's a matter of 4 to 8 weeks, but I strongly feel it might go for a quarter also. I sell real estate, one of the reasons I'm asking.
I thought you were in the market for a house.
You think Bombay prices have moved up?
Yeah, you're saying South Bombay prices are up 5%.
So a lot of this, so the judgment you have to make is, was this an aberration? Or are these shocks that are going to be frequently, happen in the future? And if you believe it's the latter, then yes, I think a lot of things will change in the world. Yeah, the beacon of peace that the Middle East was portrayed to be will cease to exist, and people will begin to move out. There are reports of some financial sector firms moving from the Middle East to New Jersey last evening, and that's going to happen. But I think the bigger rethink has to be from a government's perspective. And I'll just take 30 seconds on this. We think about the next 3 months or the next 6 months. Think about the next 3 years. What have we learned from this shock? We're living in a world that's prone to shocks. the focus has always been, let's focus on maximizing average growth. I would say an important focus has to be, how do you minimize volatility? How do you protect yourself against shocks? And that, in my mind, means a couple of things. We have to build more buffers. We've seen what China has done the last 5 years, buffers of energy, buffers of agriculture, in a world where supply chains get weaponized, right, and become fragile, and trade gets so weaponized. You need to be a little bit more self-sufficient by A, building buffers, and B, diversifying imports. So I think we have to start doing more risk management at the macro level in a world that's so shock prone.
Sir, you had a question?
Yeah. Yes, ma'am. Sorry.
Please.
Hi, Neelkant. Good evening. I have a couple of questions. See, one is that, we have been, you've been talking about how the growth is going to get shaved off in the next 2 quarters. I'll just give you a very small example. In the past 48 hours, when we saw that exuberance in the market taking place, obviously in our stock market, but very interestingly, the bond yields, they didn't move. In fact, we were steady at 6.86, okay? So is it an indication that, yields are going to shoot up beyond 7% because things are not going to be, even if the war gets over, the effect of inflation on the supply side, and then comes the demand side. It's going to be reversed this time, supply and then the demand. So both put together, that is definitely going to have an impact. And what is the kind of rate hikes that you see? Because we have seen a very sharp rate hike happening in the year 2022 across the world, including Fed, which had, I think, raised 425 basis points in a span of about, 7-8 months in 2022. And here, not only in US, but also in India, what is the kind of hike that you're seeing? And if there's going to be an enormous amount of hike, which nobody's talking about at this juncture, that definitely is going to have an adverse impact.
Yeah, thank you. I think it's a great question to think through. Look, the direct impact of oil prices is going to be a one-time spike. So if you're going from $70 to $100, unless you think that there's going to be another 43% hike next year, I don't think this really warrants monetary policy to shift, because this is a one-time shock. And especially given that we are starting with significant slack in the economy. So we are about 1 to 1.5 years behind where we would have been if COVID had not been there. So there is significant slack in the labor market. We were struggling with low inflation for a while. And this should not warrant rate hikes in India. There are second order effects where what if there are continued shortages of handsets. There are continued, because of gas shortages, if say, like I heard some tile suppliers saying that they've been asked by real estate companies to write to their RERA authority in the state that our deadlines are going to slip because we don't have tiles. Now, if those kind of supply shortages start hitting, then there is a general purpose inflation, which then perhaps warrants some action. But at this stage, I don't think that is required. What may be required, if oil prices stay high, is in addition to, I think, passing through some of the energy prices, as Sajid was saying, our response should be not to let the currency face the entire burden of adjustment, but also to reduce volatility, slow the economy down a bit, and then raise rates. So, if at all rates need to be raised, in my view, it should be to prevent excessive currency volatility. So you see, given that our currency is already, I think, 3 standard deviations weaker than trend already. So the real effective exchange rate is now down to like 12, 13-year lows. So from an economic competitiveness perspective, I don't think it warrants to weaken anymore. If people are panicking and that the currency has no end, then perhaps you need to take on some growth shock to stabilize the currency. But other than that, I don't expect this to happen. The 10-year bond yields, it's a much longer debate. I think it is because of the persistent liquidity problems that we have landed up in this soup. I don't expect the yields to stay here once the liquidity normalizes.
That is another complete conversation. Sir, you had a question.
I think ma'am has already covered my question, but if I can ask Sajid, what is your view on the US 10-year? Do you think can it cross 4.5 and all, considering the debt they are having?
Exactly. What's your? I think the US fiscal position is facing a perfect storm. Right? So think of what's happening over there. Firstly, because IPA was overturned, there's the potential that tariff revenues will have to be refunded. Now, that could take time, but that's a risk. Secondly, the longer this war goes on, the larger the fiscal cost is going to extract. So you're already starting with an unsustainable fiscal path, and then you've got deficits till the eye can see, and debt to GDP keeps rising. Now, you're thinking about central banks, the old adage, right, that if it's a temporary supply shock, a central bank looks through it. The more permanent it gets, you respond to it. Starting conditions matter. We forget the Fed has missed its inflation target for 6 consecutive years. If any emerging market central bank did that, there'd be fire, right? But we just become blasé. That is another year where inflation. So given that the Fed's running at, almost 3% core inflation, that inflation expectations, depending how you measure it, are quite sticky. There is a concern in the US that high gasoline prices, when pump prices move every day and shape inflation expectations, could, in an economy that's doing very well, growth has been very strong, spill over into core. And that's another reason why the Fed may stay on a prolonged hold. So if you think from a US 10-year perspective, a Fed that's not cutting, a fiscal deficit that's getting widening, all of this is bad news for 10-year yields.
Neelkant, if I can just ask you to finish that point, but Lata asked you about
what kind of earnings cuts?
Earnings cuts and what should we expect going forward?
Look, I think, prima facie, I think I was well above the street before this happened at about 7.5% for real GDP growth for the year. If this lasts 1 year, I think, as I said, it should be 1.5% to 2% lower than where I was. I do think that there is at least 2% of GDP growth cut that I'll have to do for the first quarter if we don't see anything changing. And remember, we are making many assumptions here. That in the effort to force Iran into concessions, there will need to be escalation. So whether the Marines land on Kharg Island or not, there will need to be escalations. And then you are relying on how desperate Iran is to retaliate. Sure. So does that mean more destruction, which is permanently takes out supplies, right? So we are talking about many challenges, but I do think that the pace of cuts, so we could see, I think as the March quarter results come through, that analysts are revising down earnings, maybe a 3% a quarter kind of rate cuts, or earnings cuts could actually resume. So we could lose almost all of the roll forward gains.
Well, I think we could go on, Lata, with lots more questions and so many directions we can go in, but out of time here on this discussion. Thank you very much, both of you, Sajid and Neelkant, for joining us on the program.
And the wonderful audience.
I just want to thank the wonderful audience here. Thank you all for being part of this program. Well, that's it on this market town hall. We've covered 3 things. We've covered, of course, global, the oil shock. We've covered markets, what to do in a crisis like this. And, of course, we've spoken with Sajid and Neelkant covering India's macros and where we stand. Thank you for staying with us. It was an interesting, insightful conversation for me. I hope it was useful for you as well. Thank you for staying with us.